So let's start with types of residential mortgages. There are two types of residential mortgages. Okay. Fixed and floating rate are the like interest rates charged on people who take loans. Okay. So like types of mortgage, residential mortgage products, let us see. Whenever you go for a loan, you approach a bank for loan. They will give you a loan based upon your security. So the security will be nothing but your property, what the property documents you have. You can mortgage it and take loan from bank. Okay. So types of residential mortgage products. A mortgage is a loan that has a specific piece of property as collateral, which I said right now. So if you want loan from bank, you need to put your property as a collateral with the bank. Okay. In the 70s and 80s, mortgages existed solely in the primary market, where banks would issue mortgage products to customers who would in turn repay the principal plus interest. Mortgage product is nothing but we will take your property documents with us as a collateral and we will give you loan, and in turn you need to repay the principal and interest to us. That was the condition of the bank. But in the modern times, that was originate to hold model, now it is originate to distribute model. Mortgage lenders now repackage mortgages. That means now it is not the case of primary. They will convert those mortgages into securitized securities, and they will sell it in the secondary market, okay, as investments. People can purchase them, and they will get interest on that. Now in the secondary market, mortgages are pooled together, like a lot of mortgages they will be having banks. They pool it, repackage to form mortgage backed security, and that they will issue to public. And with that money, what they get, they can give loans to people who approach them. Okay. So the principal and interest payments pass through bank before the bank hands them over to the mortgage backed security investor. So what happens, the principal and interest payments, so whoever has taken loans from bank, they have to pay the interest and principal, that is EMI. In today's world it is like EMI. Okay. Now that bank will get, and bank will give the bank which is liable to pay to the mortgage backed security investor, bank will pay them interest, and also bank needs to repay them back the money what bank has taken from them. So bank also needs to make the payment to them, which is principal plus interest. And such a mechanism is referred to as the pass through structure. Why it is pass through structure? Why? Because when you mortgage your property with bank converted that into MBS and issued to public. Now like when you have mortgaged your property, now to take your mortgage back, you need to repay to bank. So bank will get principal plus interest. Now bank in turn has taken loan from public by issuing securities to public. Now bank needs to pay them interest and principal. So what you give to bank, banks give to them. That is pass through structure. Okay. Now lien status. So lien is nothing but if you don't make the payments, bank has the right to lien. Okay. Right. They have the right to lien. That means they can sell your property and get their money back. Fine. So the first lien mortgage is more desirable than a second lien mortgage from the perspective of the lender. In the event of liquidation, a first lien status would give the lender the right to submit the first claim on the proceeds of liquidation. That means lien is nothing but your property, whatever is with the bank. If you don't repay the money to them, they can sell your property or liquidate your property and get the money, whatever they are supposed to get. That means they'll auction your property and get the money. Now, original loan term. See, long-term mortgages have a maturity period of 30 years. That's the maximum. Housing loan in India is also having a maximum period of 30 years, but some people take loan for 10 or 20 years also. Credit classification. So, the tranches what we have discussed in the previous past very clearly. And all these chapters again and again are repetitive in nature, and with this you are developing your conceptual knowledge of banking sector. So prime A grade loans take the top spot as the most desirable loans. That means A grade, that is the best one, whereby the risk is less to the bank. Why? Because those are the ones which will repay. Okay, that means the first tranche, the investment grade. So here what happens? The loan to value ratio is less. What is loan to value ratio, Chandra? LTV. Hello, hello, Chandra. What is the loan to value ratio?
Hello?
Yeah, what is
Hello, sir?
LTV ratio? Loan to value ratio.
Hello, sir?
What is loan to value ratio? Loan to value ratio. LTV ratio.
LTV ratio.
Yeah.
I think it's a loan amount by, I think, appreciation value.
What?
Loan amount by appreciation value, sir.
No, like, can you just give me a small example of that? Suppose you have a property and
They are putting
the,
for a value.
yeah, the property value is like 5 lakhs, 50
5
lakhs.
lakhs, I think it's going to be increased, I think so, sir. Because,
No,
no,
see,
actually, they needed some amount from the bank side. They
yeah,
are
yeah.
mortgaging some
Bank,
assets
bank,
in the
bank
bank.
bank needs to pay 80%. You need to pay
Yeah.
20%. So the loan to value ratio is nothing but what bank is paying for the property value. What loan you are taking for the value of the property. Property value is 50 lakhs, loan is 40 lakhs. So 40 lakhs by 50 lakhs is 80%. That's the loan to value ratio. Got it?
Okay, sir.
This loan to, so 40 lakhs is what bank is giving you as loan, 50 lakhs is your property value. So loan 40 lakhs to value 50 lakhs, loan to value ratio. This should be
Yes, sir.
less actually. How much less it is for the bank? That much good for the bank. How much it is
Okay,
more?
sir.
That much the bank is at risk. Okay. So you can
Okay,
clearly
sir.
understand if the loan to value ratio is high, the banks are at risk, at higher risk. But in the prime A grade, the first tranche, what we discuss, in that the loan to value ratios are very less. Why? Because are paying 20-30% as down payment and taking the loan. And they have good and sufficient and stable income to pay. But subprime mortgages, the loan to value ratio will be high. They will be taking higher amount of loans and will be giving very less down payments. So here the chance of default is very high. Now alternative A loans lie in between. So some loans lie between the prime and subprime. Some people they pay between these two category. One is very good category, one is very bad category. So the ones which are in between them is prime loans. But there are certain characteristics which make the prime loans also very riskier. For instance, there may be less documentation available to support income levels. Yeah, that means they are having good income. They are like strong people, not a problem, but their documents are not proper, which does not support their. Today they may be good, but in future we doubt them. Okay. Interest rate type. See, your loans, whatever you take from bank can be like a fixed interest loan or floating interest loan. Fixed interest loan in the sense whereby you will be paying fixed interest up to maturity. But if I speak about floating rate, you will be paying LIBOR plus the basis points, whatever. Okay. Fixed rate mortgages, principal and interest payments. Now let's see about this. So if you have taken a fixed rate, okay, if you have taken a fixed rate loan by mortgaging your property, what is the principal payment and the interest payment you are going to make to them? And see, fixed interest mortgages are the loans. Mortgage loan is nothing but are given to those people seeing their credit worthiness, if the borrower is eligible for that, okay, etc. Level of interest depends upon the credit worthiness of the borrower, whereby the riskier borrower, the higher the interest rate. Now the low interest rate is for the people who are whose profile is very strong and there is less risk to the bank to give them loans. Okay, so it all depends upon that. Other notable characteristics of fixed rate mortgages include consist of equal payments over life of the mortgage. That means, EMI, you have to pay a fixed EMI till the maturity of the loan. A loan is amortized over its term. So slowly, steadily, as you make the payments, the since like whenever you take a loan, in the beginning you pay very high amount of interest and less principal, but as the time passes your interest will be less and your principal will be going on increasing. That is the setup they do. So that is called amortization. So slowly steadily your principal will be high and your interest will be less. Amortization of interest happens there. And as the loan matures, the amortization schedule works in such a way that the borrower pays more principal and less interest with each payment. So that's what like it happens. As I said, you right. In the beginning, the interest will be high, but slowly, steadily, the interest will be reducing and the principal will be going on high. Okay. So as you pay, as the time passes on, interest amount will be higher with the passage of time, and interest amount will be lower with the passage of time. But in the beginning, interest is high and principal is less. If you want, I can show you some calculation here. Let's see now, suppose your loan amount is 50 lakhs and you are going for a 30-year maturity, the tenure, and the interest rate charged is 7.2. Okay. So 50 lakhs. So your EMI is 33,838. You can check it here. Fine. So that is what it is. And here is the loan amortization, like the amortization schedule. In the beginning, the monthly interest is this, principal is this, but as you go on slowly, steadily, your interest amount, your principal amount is going on increasing, your monthly interest is going on decreasing. And after 30 years, 360 payments, that means you need to make your like see your principal is this and your interest is this, almost it will reduce. Okay, so this is the way. So we have seen a practical example. Now Chandra, you need to calculate this, calculating the amount of each payment. To determine the amount of each scheduled payment, we customize the formula for the present value of annuity. When will we use the present value of annuity formula, Chandra? Hello, hello, hello. Yeah, Chandra, are you hearing me? Hello. So when we'll be using this one? When we'll be using this one, annuity formula, Chandra, can you answer my question? Hello. Okay, see, annuity is nothing but if you have some single set of payment, that is if you are paying interest and that interest is a fixed payment for some longer period of time. So so that we will say we will use the formula called annuity, that is present value of annuity formula, to find out the present value of some payment. Suppose 8,000 is the interest amount which you need to pay every year. 8,000 is the interest amount which you need to pay every year. Okay. You need to pay that for 10 years. So that's, and the interest is like somewhere around, rate of interest is 8% something. So you need to pay it for 10 years. So your time period is 10 years. So after 10 years, the interest which you are paying is 80,000. So what is the present value of that today? We can do that with the normal present value formula also, by finding out the present value factor of every year and discounting the 8,000 payment which is supposed to pay at the end of the year. we can discount that and find out the present value of those 8,000 every year, those 8,000 payments every year, and calculate it and get the present value as on today. But that is a very long process. Instead of that, you can use the present value of annuity formula. This is the present value of annuity formula. Use this and find out your present value of those fixed payments. So here the formula is payment is nothing but what the money you are supposed to pay into 1 minus 1 plus r rate of interest whole power minus n, that is the number of periods, by r, that is nothing but the rate of interest. Okay. Hello. Yeah, Chandra, tell me. I'm calling you. Where are you? No, this call is there. Call is recording. Just a second. Shall I call once again? Okay, 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 okay.